What if you could invest in real estate without buying a house? Forget massive down payments and endless repairs. Today, I'll show you how. I know that feeling. Home prices soaring, friends buying houses, and you're thinking, how? How are people doing this when I'm just trying to pay rent and student loans? It's easy to feel real estate wealth is reserved for the wealthy. The financial realities for many can feel like an insurmountable mountain when you consider down payments and closing costs. It's a valid frustration. For many, buying a physical property simply isn't an option right now, and that's okay. Your financial journey is your own, with many roads to wealth. But here's the empowering truth. Real estate investing isn't a one-lane highway. There are different avenues, some more accessible than you might think, that allow you to participate in this powerful wealth-building sector without needing hundreds of thousands for a down payment. Today, we're going to dive into two fundamental ways to get involved in real estate, comparing the traditional path of buying a home with a much more accessible alternative: real estate investment trusts, or REITs. My goal isn't to tell you which one is better, but rather to equip you with the knowledge to understand which path might align best with your current situation, your goals, and your financial comfort level. Because at the end of the day, the best investment is the one you understand and that works for you. Let's start with what most of us immediately think of when we hear real estate investing. Option A, owning a physical property, typically your primary residence. For generations, buying a home has been touted as the quintessential American dream and a cornerstone of personal wealth. And for good reason. There are some incredible benefits to owning your own home. First, there's the stability and sense of permanence. Having a place to call your own, to paint the walls any color you like, to plant a garden, that's a powerful emotional and psychological benefit. From an investment perspective, one of the biggest draws is the potential for appreciation. Historically, real estate tends to increase in value over time. For example, the U.S. median home price has increased by an average of approximately 4% annually over the last 3 decades. While past performance is never a guarantee of future results, it demonstrates a long-term trend of value growth. As your home appreciates, your net worth grows. Another major benefit is what I call forced savings. Every mortgage payment you make, a portion of it goes towards paying down the principal of your loan. This means you're building equity, an ownership stake in your home with every payment. It's like a savings account that you're compelled to contribute to every month. Plus, there can be tax advantages, such as deductions for mortgage interest and property taxes, although these benefits have changed over the years with adjustments to standard deductions. However, the path to homeownership isn't without its significant challenges, especially for those just starting out or grappling with other financial burdens. The most immediate hurdle for many is the upfront cost. We're talking a substantial down payment, 20% to avoid PMI. On a $400,000 home, that's $80,000, a huge sum. Then add closing costs, 2%, 5% of the loan, covering appraisal fees, title insurance, legal fees. So, a $400,000 home could easily require over $90,000 cash out of pocket just to get the keys. A daunting figure for many, and that's okay. But here's what most people don't factor in before buying a home. But the costs don't stop there. Once you own the home, you become responsible for ongoing expenses that renters don't typically face. We're talking about property taxes, homeowners insurance, and most significantly, maintenance and repairs. Experts often advise budgeting 1% to 4% of your home's value annually for upkeep. That means on a $400,000 home, you should expect to spend $4,000 to $16,000 every single year on things like a new roof, HVAC repairs, plumbing issues, or even just routine yard work. Trust me, a burst water heater is not pretty or cheap. These are costs that can sneak up on you if you haven't planned for them. Finally, there's the issue of illiquidity and lack of diversification. Your entire investment is tied up in one asset, your home. If you need cash quickly, you can't just sell off a piece of your house. Selling a home is a long, expensive process. And while home values generally rise, market downturns like the one we saw in 2008 can happen, impacting your single largest asset. It's a significant concentration of your wealth. So, if that feels overwhelming, if it feels like a hurdle too high to clear right now, please know you are not alone, and it does not mean your real estate investing dreams are dead. That brings us to option B, real estate investment trusts, or REITs. REITs, pronounced REITs, offer a completely different and often far more accessible entry point into the world of real estate. Think of them like mutual funds, but specifically for real estate. When you invest in a REIT, you're buying shares in a company that owns, operates, or finances income-producing real estate. Instead of owning a single house, you're owning a tiny piece of a diversified portfolio of properties. Things like apartment complexes, shopping malls, office buildings, data centers, warehouses, and even hotels. You can buy and sell shares of REITs just like you would any other stock on a major exchange. The biggest advantage of REITs for many people is the low barrier to entry. You don't need a huge down payment or closing costs. You can invest in a REIT for as little as the price of a single share, which could be $50, $100, or a few $100s. This makes real estate investing instantly accessible, allowing you to build wealth without saving for decades. Another huge plus is diversification. Instead of all your money being tied up in one property in one location, a single REIT can own dozens or even hundreds of properties across different sectors and geographies. This spreads out your risks significantly. You're not relying on the appreciation of just one house, but rather the collective performance of a whole portfolio managed by professionals. And this next part is why REITs are a game changer for passive income. REITs are also known for providing passive income through dividends. By law, REITs are required to distribute at least 90% of their taxable income to shareholders annually. This often results in attractive dividend yields. For example, over the past decade, many REITs have offered dividend yields in the 3 to 4% range, often higher than the broader stock market's average dividend yield. This means you get regular income just for owning shares, which can be reinvested to buy more shares, compounding your returns. Lastly, REITs offer liquidity. Unlike a physical property that takes months to sell, you can buy and sell REIT shares on the stock market relatively quickly, usually within minutes during trading hours. This gives you much greater flexibility with your investment. However, REITs aren't without their downsides either. You have no direct control over the properties. You don't get to pick which building they buy or what color they paint the lobby. You're entrusting that management to professionals. Because they trade on stock exchanges, REIT prices can be subject to market volatility. A downturn might temporarily lower your share's value, even if the underlying real estate performs well. And while you get dividends, you don't get the same tax deductions for mortgage interest or property taxes that direct homeowners do. Also, if you're investing through a REIT ETF or mutual fund, you might incur management fees. So, knowing all that, how do you actually decide which path is right for you? So where does that leave us? What's the verdict? Both traditional homeownership and investing in REITs are valid and powerful ways to get involved in real estate. Neither is inherently better than the other. They simply serve different purposes and suit different financial situations and goals. If you're looking for stability, a place to call your own, and have the significant upfront capital and stomach for the ongoing responsibilities and illiquidity, then buying a primary residence can be an incredible investment and a fulfilling lifestyle choice. It's a long-term play that demands patience and commitment. If, however, the idea of a massive down payment feels impossible right now, or you're seeking to diversify your portfolio, generate passive income, and maintain liquidity without the headaches of property management, then REITs are an outstanding option. They allow you to participate in the real estate market with a much lower entry barrier and greater flexibility. It's a pure investment play, separating your living situation from your real estate wealth building. Many savvy investors actually use both strategies. They might own their home for the lifestyle and forced savings aspect, while also investing in REITs for diversified exposure to other real estate sectors and consistent dividend income. It's not an either-or scenario. It's about building a well-rounded financial strategy that reflects your unique circumstances. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making financial decisions. The actionable takeaway I want you to walk away with today is this. Don't let perceived barriers stop you. Today, take one concrete step. If homeownership feels years away, research one diversified REIT ETF that aligns with your values. If homeownership is your dream, grab a spreadsheet and start calculating all the costs for a home in your desired area. Not just the down payment, but closing costs, property taxes, insurance, and that critical 1 to 4% annual maintenance budget. Understanding is the first step to action. Which path sounds more appealing to you right now, and why? Share your thoughts in the comments below, and let's keep this conversation going. If you found this helpful, please hit that like button, subscribe for more empowering financial insights, and ring the notification bell so you don't miss our next video. Until next time, keep learning, keep growing, and keep building that financial future you deserve.